We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. Mike, thanks for joining me.
Tom, thanks for having me back on.
It's always excellent to talk to a more handsome reflection of myself here.
Yeah, well, I think we are bookends. But I do appreciate you give me the opportunity to play show and tell. Like, vast majority of my job is seeking inspirational things to write about all the time, and once in a while I get to talk about it. So thanks for letting me do that.
Oh, it's always a pleasure, and you have such a way of really not only explaining these things, but really linking a lot of these ideas together. So why don't we start with, obviously you're commodity strategist, but what portion of the commodities market right now is kind of, in your estimation, showing us where inflation could be headed?
Most notably, the most significant commodity on the planet is crude oil. It's down 9% on the year. There you go. That's a problem. Grains, the most elastic commodities, they start with the elasticity. Corn's down, 16% on the year? Soybeans are down, wheat's down. Everything like that's heading down. The number one reason those highly elastic commodities, starting with the grains, are down is because they went up too much to the peak in 2022. It's always the lesson to commodities. Deflation comes from inflation. Commodities go down because they went up, and we're doing that now. The key thing that's next, the next shoe to drop, is potentially industrial metals. Bloomberg Industrial Metals is basically flat on the year, maybe up 1% to 2%, with the stock market up 8% and the dollar down 8% or so. That's a real bad sign. So I think industrial metals are next potential shoe to drop, to fall what I call the 3 C's of commodities: crude oil, corn, and copper. Of those three, 2 are heading lower. And the last one's copper. It looks like it just put in a pretty good peak. And I think the risk just drops down to some little bit of normal autocorrelation, which it always does. And I'll just put a number on there. As we speak on August 5th, copper in the US is about $4.40. Typically goes back to $3.
Mm-hmm. So I think this is always kind of a chicken and the egg thing. Is it that commodity prices are, let's say, the cause of inflation or deflation, or is it the monetary path that the Fed and the Treasury choose at this point that are more responsible for that? So how do you kind of analyze that problem, especially in this environment where there are so many differing, let's say, cross currents that we have to try and take into consideration?
Well, the answer to that is yes, because that's one thing I love about markets is the questions can be always the same, but the answers are always different. That's what's really significant. I've enjoyed explaining to that some of my senior managers sometimes when I have differing views from the consensus. And number one, I think it's number thing, remember in commodities, if your consensus you're on, you're nothing special. Against consensus is usually how it works. For instance, being bearish, crude oil when it popped above $100 a barrel in 2022, way early, stopped out if I was a trader, but now we're heading towards $40 a barrel. I made that call 3 years ago because it's what always happens. So to me, I'll put in the current context is what's happening right now. We've had the biggest money pump in history. We pumped up everything, most notably commodities, and at the same time, we had the Russians' invasion of Ukraine. That was a perfect storm for an enduring peak in commodities. So far, the high in crude oil has been 130. Right now, we're 65, so it's down almost 50%. The high in corn was around 8. Right now, it's 4, below 4. The high in natural gas was around 10. Right now, it's about 3. The only commodity that's really gone higher is gold, and to some extent copper. It got up there a little bit. I mean, major commodities that trade in a broad-based futures market, which is really my background, trading pits of Chicago. Mm-hmm. And that is because of deflationary forces kicking in. Number one way to indicate that is let's look at the most significant demand pull source for commodities on the planet. That's China. 1.71 is their current 10-year note yield. In the U.S., the current yield is 4.2%. Severe deflationary forces in China. Ignore what they say, watch what they do, and that's all data can be surveys, but the one thing you can't mess with is a bond yield, and especially sovereign bonds. So I see severe deflationary forces, but it's within the context of normal cycles. 2 books, The Price of Time by Edward Chancellor, pointing out all the biggest pumps in history and liquidity are followed by deflation. That's what deflation is. It's inflated assets, inflated things going back down. It's always on the back of inflation, almost always. And The Price of Time, the great Canadian Jeff Booth. Price of Tomorrow, Jeff Booth, who pointed out the severe deflationary forces of rapidly advancing technology. I mean, how many photos can I get for free on my phone now? It's just shocking. Look what happened to Kodak. So this is what's happening in the space. And so I always tilt over what's happening in the macro. We all know what's happening with electrification. That's part of the reason that at least copper's up 10% on the year and crude oil's down 10% a year. The thing is, copper's so much more macroeconomic, and that macroeconomic tilt is downward. And I just look for signs of that changing. So I'll end with what I think is most significant potential deflationary forces just waiting to happen, just a matter of time. And that's the U.S. stock market just having a little bit of normalization.
I mean, there's so much to pick up on there, Mike. But let's take what you see or what you're expecting for deflation for the rest of the year. Again, this seems to be somewhat of a non-consensus view, especially as we've seen a little bit of an uptick in the actual CPI numbers here. So why is it that you're seeing deflationary forces coming, and is it mostly driven by that extreme, let's say, force within China that you mentioned earlier?
If I'm consensus, I offer no value, and I have to take the risk. Now, you see, I've lost my hair of being non-consensus, but also when I have very strong convictions and feelings based on data and history and things I see happening. So I think by the end of the year, we're going to have a down year in the stock market. Right now, it's up 8%. That's the S&P 5 total return. Now, that's a significant shock from consensus. Mm-hmm. The consensus at the beginning of the year was 10% gain. We had that, and then people added on another 10%. See that part of human nature that happens when you get to the end or near the end of significantly stretched bull markets. To quote my colleague Gina Martin Adams, who's our equity strategist, we've reached a mania stage now in equities. Can't pick a peak, but she said that back in February, March, and we got to 27, almost 20% correction. Now that's a short-term thing. The sharp rally we had was the sharpest ever, but it's the key thing to remember about inflation and deflation. The lessons of there's only 2 times in history, major examples of markets and countries getting more expensive than the U.S. stock market is now versus GDP, versus the rest of the world, versus commodities, versus gold, versus sales. Those are the key things I watch, and that is 1929 in the U.S. and 1989 in Japan. Now I'm somewhat a bit jaded. I started in the business in 1988, working at the Chicago Board of Trade night session. And my clients, guess what? At night, we're all Japanese. Been there, done that, seen it. And then I started trading JGBs in the mid-90s, seen that collapse in bond yields, which is the same thing that's happening in China right now. So all lessons of history are deflation comes from inflation. And we have the most elevated stock market in history. And I published recently the comparison between President Herbert Hoover, who was elected in 1928, and President Trump was elected in 2024. The 2 key things they have in common is U.S. stock market to GDP at over 2x. Now, there's so many other measures. There's always a good reason. It could stay there for longer. When I write my book from the future, am I going to write it was different this time or it wasn't different this time? And that's why I just point out looking for signs. So what I see happening, the key indications are what's happening with gold. You look at gold versus almost all commodities, most notably from my colleague, Mr. Grant Sporey, who's our metals analyst in London, and also another colleague, David Zong, who does models. Virtually every model shows that copper was way overpriced and still is way overpriced versus except one key metric, the U.S. stock market. So I love watching that metric. You take a stock market divided by gold over time. Historically, it's basically 1 ounce of gold is equal to the S&P 500. And just like the end of last year, it was like 2.2 ounces of gold equal to S&P 500. Now that's starting to tilt back downward. I think that's going to continue, where gold's going up a lot more than the stock market for good reason. Central banks are buying a significant amount, and ETF outflows for the last 4 years have switched to inflows. So there's a bit of a shift there. But to me, that's where the macro is kicking in, is that and then also the thing I really love, Tom, is there's a complete consensus that people are piling on the last big trade. The last big trade was that big inflation pump. And every time I hear people buying cryptos, I'm like, oh, we have to help for debasement of currency and inflation. I'm like, sorry, but that's the last big trade. That time to do that trade was 2020, in the beginning of the year, when people like Michael Saylor of Strategy discovered Bitcoin and got a 10x. But now that they're doubling down, you put on your spidey senses, rational things, is, do I really want to join this highly volatile risk asset when everybody's piling on? And to me, that's the big risk now. The big risk, I think, is by the end of the year, and I'm willing to stop myself out if we're wrong, is that the best performing assets will remain gold. I think gold's going to just continue higher and get above 3,500 an ounce. And U.S. Treasury long bonds. And some of the worst performing assets will be the U.S. stock market led by cryptos heading lower. That's my outlook right now. Copper's part of that downward tilt. It's already started going there. Commodities going lower, crude oil going lower is part of that, led by the less macroeconomic significant grains, but they're part of that cycle. To me, that's where we're going right now. And the key thing to stop me out in that view is if that U.S. stock market keeps going up, and I suspect it's going to go down. So here, I'll end with this. One little trigger. It's August. It's the summer doldrums. It's time of the year where everybody's fine and hanging out on the beach and riding motorcycles and loving it. But the key thing that just happened recently was 30-day volatility on beta, the S&P 500, just dropped to 7.2%. The last time it stayed more than 5 to 10 days below that level was in 2019. So it's a lesson I learned trading options, the Chicago Board of Trade, is volatility is always mean reverting. When it gets that low, it always goes back up. Now, that means just a short-term trade. Yes, we all know we're due for a 5% correction in the stock market. It's what happens after that. And then there's things, I'll point out one more thing. I think one thing the gold market loves, absolutely loves, is President Trump pushing back on the Fed, pushing back on any data from U.S. government he doesn't like. Gold says, thank you very much. We'll buy more.
What does say the behavior of gold and T-bills, as you pointed out? This is an interesting combination that I found kind of going through your X feed here. What is that telling us about the state of risk assets? And if you could just, maybe for those that wouldn't understand that term, Mike, if you could just kind of give us a quick overview on what a risk asset is, like the risk on condition that we're on.
Anything that if you buy, you can lose it's maybe as much as you paid for. For instance, the riskiest assets, I think, right now that are top of the radar are cryptocurrencies. Bitcoin is number one, but now there's 19 million. It was number one in 2009, and now there's 19 million. Just the simple lessons of supply and demand says, yeah, that's a problem, way too much supply. Let's look at a risk-off asset. Gold is considered a store value risk-off asset. Yes, it does fluctuate, but there's gold, and then there's three other similar precious metals. See the difference? 19 million cryptocurrencies, unlimited supply, 3 precious metals, limited supply. Okay, I get that. I'm still sticking with that. But to me, the number one measure of risk assets on the planet is S&P 500. It's beta for the planet. I worked at S&P 500. Where's the index? I worked at a hedge fund. We use S&P minis is our measure for all risk. It's beta. If S&P 500 drops 10%, the whole world goes down. If it goes up 10%, that's what it always does. I mean, that's the key thing that matters. So that to me is what's going to be a matter. So people who have risk assets, your home basically can be considered a risk asset, particularly if you're an average person who puts 20% down and leverage 5 to 1 buy a home. If your home drops 20 or 30% and you're highly leveraged, that can be considered a risk asset. But basically, it's things that we invest our money in. Number one typically is the stock market. Now, risk off assets, the number one risk off asset in stock market asset on the planet is U.S. Treasury T-bills, supposedly the safest assets on the planet. I say that supposedly because it's been pushed back a little bit. And my lessons, every lesson I've learned having traded Treasuries since I first started in Treasury bond futures in 1988 is that anytime people tell me the yields are going to go up and rates are going to go up because of excessive supply, that's usually been a time that points out yields are going to go down. So to me, this is the next big trade. Is one thing I'll point out. So gold has been one of the biggest trades for the last few years now. It's been outperforming the stock market for almost 5 years. It's been actually the same. That Bitcoin to gold ratio has been the same since 2021. So it's actually keeping up with Bitcoin and leading it this year. And the key thing that gold is that it's always kind of had a decent correlation with, Treasury long bonds. I mean, if you look at the longest of long bond, it's 30 years, and even the longest is a 30-year zero coupon bond, where you just buy that bond at a discount and it goes back to par over time. So right now, the key thing I point out about gold is it's been the risk off asset. People are using it for store value and for safety. It's the most expensive ever by some measures. I guess going back 50 years versus that UST bond. I said that 2 years ago. Darn, I've been wrong. T-bills haven't really done anything. They've given you a coupon, but gold keeps going up. So I think the next trade, when the U.S. stock market corrects, and hopefully it's in my lifetime, I think it's going to start this year. Hopefully, I think it's going to start this year. Well, people have heard it before. Honest engine, yes, I've been wrong, but I pointed out better assets. I certainly was a much more advocate of Bitcoin for the last 5 years. Certainly 19 and then 20 specifically. But lately I've been really scared, pointing out for the last almost 5 years how gold's beating stocks. The rock beats stocks. That's a bad sign. So far this year, gold's up about 30%. Stock market's about 8%. Just imagine iteration. And if we stay here, that's fine. If we keep going higher in stock market, that's wonderful. That's what's priced in. It's the optionality of the next big trade that I expect to keep in, and that is the stock market starts giving back those gains as the U.S. heads for that recession that we didn't get 2 years ago, but for really good reason. Tariffs. What's the number one thing that these tariffs are going to do is going to hit corporate profits, and that's what drives the stock market.
Well, that was exactly where I wanted to go is, what do you think kind of precipitates this correction in the stock market? Is it just this reversion to the mean? Is it earnings? So, let's elaborate on that if you could a little bit more, Mike, like the idea of how tariffs are going to affect these corporate profits.
Well, the number one thing tariffs are doing, first of all, is pressuring the whole rest of the world. The vast majority of it has, for the last 50 years, has become over-dependent on net exports to the U.S. A thing I learned when I worked in the trading pits, and I got my MBA at night, and of course, in the MBA, you learn all those academic things. Free trade's great, and that's what we all need to do, free trade. Then I remember getting on the phones. I was always on the phones with clients, a lot of them in London. They'd say, yeah, everybody in the world wants free trade as long as they can run net exports with the U.S. And that turned out to be the fact, and that's true. That's what Mr. Trump is cutting off. And you're seeing that what's happening in the rest of the world. Now, U.S. imports of goods have just spiked, and now they're collapsing. And I just will be publishing by the time this comes out, pointing out that collapse in the imports of U.S. goods is as certain as death and taxes. It's going to continue to collapse. So that's not so much an indication for the U.S. We'll see what that means. I'll get to that in a second. But it means what's happening to the rest of the world. And you've seen that's what happened in China. They're getting shut off, so they're trying to find export markets, and the whole rest of the world is pushing back a little bit on massively cheap exports from China. The one little story that came out recently, there was a story in the New York Times about Indonesian exporters getting hammered and people losing their jobs and having to just to drive Ubers and things. And I'm like, well, I grew up in the Midwest. I kind of grew up with that. I remember people losing their manufacturing jobs and this happening. There was another article on the Bloomberg Terminal recently about the wine industry in France and might be losing a billion euros in the next year or two and lose 600,000 jobs. Like, again, I'm sorry, but for I don't know how many years, France charged 20% wine on U.S. imports into France, and U.S. charged near zero. Well, sorry, but that's been cut off, kibosh. You could say thank you, but that's again, guy from the Midwest. I grew up hearing that and seeing that with people who, I was kind of grew up in a blue collar town who just. It changed. And yeah, it wasn't just because of but a lot of it was massive predatory exports from China and the rest of the world, taking away some of these U.S. businesses. Now that's being turned around. So you're seeing the whole world's going to be pressured. That's going to kick in industrial metals, which I think just on the cusp of breaking down. It's going to, and it's just a matter of time to hurt corporate profits. So right now, corporations are eating some of that. It's going to pressure that inflation in the short term. But remember, this is back to the U.S. 2/3 of U.S. economy is services. And what we saw today as we speak on August 5th is the U.S. Service Employment Index just dropped to the lowest level in 4 years. So they're not hiring people. That's a problem. But that's the key thing is corporate profits. The number one reason if you own a plant in the U.S. of any type of manufacturing in the heartland, and you did the absolutely politically incorrect thing to shut down that plant and put people out of work who sometimes you went to high school with. The only reason you would do that is because you had to do that for survival to keep your corporate profits up. Boom, that's being shut off. And that's what, to me, it's going to happen. We're going to hurt corporate profits. But the key thing to stop the stock market is only one thing, Tom. It has to stop going up and go down. When you get to this point, it's a frenzy mode. Very akin to, like I pointed at, 1929 in the U.S., 1989 in Japan, and things I remember in 1999 and 2007. 2006 in U.S. housing market is the only thing that stops is when prices stop going up. And one way for that to happen is when earnings beat and we start going down. That's happened a little bit. We've had a lot of earnings beats, and the stock market's gone down a little bit. And then at some point, it's all self-fulfilling and it trickles down. That's my point. We're at such a self-fulfilling, somewhat Ponzi scheme now that something's got to trigger it down lower. What are the key leading indicators? I'll watch gold, cryptocurrencies. On the year, here's my key thing I'll end with. On the year, the Bloomberg Galaxy Crypto Index is up about 7%. It trades 3 to 4 times the volatility of the S&P 500. It has a very high correlation with the S&P 500, and it's up less than S&P 500 in the year that it's a bull market. That's a real bad sign for these highly volatile, speculative digital assets that were born of the Great Recession. And now I think they're going to be the first signs of things collapsing and going down. Well, not necessarily collapsing, but normal reversion of highly volatile, of very expensive risk assets.
Are they still very correlated to the NASDAQ and these tech stocks
Oh,
as
sure.
well? Mm-hmm.
More so than ever. So I just looked at recently just a 100-day correlation of Bitcoin to the S&P 500. I use the S&P 500, very similar to obviously NASDAQ, is about 0.56, almost 0.6. And the 100-day correlation of Bitcoin to gold is negative, almost 0.7. So it's a key thing I published for years, is Bitcoin digital gold or leverage beta. Well, sometimes it's more digital gold and sometimes it's more leverage beta. Right now, it's very much leverage beta. And I think that's the risk, that it's going to lead the way lower. Maybe the crypto market much more than Bitcoin. Bitcoin's still the outlier, but that's the key problem. There's 19 million cryptocurrencies now, and every one of them has a legitimate use case, except some of them are just silly expensive. Things like Dogecoin, worth $30 billion. I'm looking for the trial I'm looking for this space is very similar to what I was looking for. And I remember well with internet stocks in 2000. Once we wipe out some of the excesses, purge them, get them back to zero, or lose 90%, then we can reset. But we're nowhere near that, but maybe we're starting. And by the end of the year, we might have a clear indication. Obviously, I'm making my base case we'll be heading that way.
Mm-hmm. So Mike, you mentioned the idea of how tariffs have affected many of the markets that we've seen. Like it's been very volatile this year. How did that? Let's take the case of copper. Trump announcing that 50% copper tariff, and did that basically drive copper up? And it's now, let's say, we have to take into consideration that it was driven up in conjunction with this lack of demand also coming in right now.
Absolutely. It's what you happen in copper this week is this month, last month, July, is very akin to July 2008, what happened with crude oil. I remember it vividly, got that trade right. Don't always get them right. This one, I think I'm going to get right in the long term. When crude oil peaked at $147 a barrel and the average gallon of a gasoline in this country jumped up to $4, that was a sign of the end of the beginning of the end, and then everything collapsed. Copper just did that. The Metal Med said they have a PhD in economics. Now, we all know why the U.S. price spiked is because of tariffs. But tariffs are also part of the big picture. And then we found out we're not going to be tariffing refined copper, which we thought was silly in the first place. But now that it's collapsed back down to $4.40 from the high of $5.96, the highest ever, that high, $5.96, could last for a long time. I shouldn't say never, but that crude oil high at 2008 still stands. 2022 pumped at 130, and now we're still below that level. These kind of things usually happen in commodities. Once you spike on such high prices, you usually have very enduring hangovers. And typically when you spike like that, to get too expensive, you always have to find a too cheap level to find a trial. And I don't think we're anywhere near that. So I've heard another colleague today ask me if I should buy copper. And I say, well, good luck. I think it's had an uptrend line since 2020. That trend line comes in around $4.15. The key mean is around $4. I think it's going to break that trend line and goes lower. All the indications for copper technically goes up, which means at some point there's just too many people leading that way and it goes back down. And to me, that's my counter consensus call. It's going to kind of lead the way. But what are the guidance for that? Crude oil has already done it. Equally economic sensitive. Grains have already done it. Corn's in that space. What's happening in China? What's happening in iron ore? It's basically stuck below $100 a ton forever, and it's heading lower. And what's happening with 10-year note yields in China? So I'll end with this. Copper right now at $4.40 a pound. You can overlay that with the U.S. 10-year note yield and just put them in the same. It's right now $4.20, 4.2% yield. They're both, I think, heading towards 3. It just needs some kind of trigger. And the biggest trigger on the planet is the U.S. stock market just giving back some of its extraordinary gains of the last few years, which is always the way it happens, is mean reversion. It feels horrible, but if you look back from 5 or 10 years ago, people have still had major gains, but it's usually not how humans look at things.
Mm-hmm. So, Mike, how do you think, you mentioned that gold and T-bonds are your, let's say, favorite assets for the rest of the year here. Do you think that part of that rollover in the stock market starts to come into gold, and maybe if we get to that, let's say that nice, pretty round number of 4,000, that also provides some momentum and attention for gold?
So I think it's going to be, it's already happening right now. So let's look at gold. ETF holdings are up 10% this year. For the last 4 years, they've been down every single year. So that's a substantial shift in sentiment. So there is a lot of that. I think any smart, astute investors who are getting way overweight equities, certainly US dollar denominated equities, now they're expanding overseas into other assets. What's the simplest one that's kind of outside of the dollar? in this country is gold. Now, I've heard this from many sources that, you take those expensive dollars and U.S. assets and diversify overseas. That's happening. So gold's definitely happening. What accelerates that? The key thing I point out is that gold, as we speak right now, is just below $3,400 an ounce. It's hovering around there. Traded there first in April. That's 5 months in a row of unchanged. It's a bull flag, just waiting for an excuse to go higher. And I think the excuse will be stock market going down, but gold seems to be front running a little bit. Again, we have central banks buying, but I do love the World Gold Council's data on that, where they point out central banks have curtailed their buying. 3 years in a row, they bought over 1,000 metric tons a year. This year so far, it's about 500,000. Yeah, okay, they're slowing down. That makes sense. But they also pointed out the recycling is not kicking in, and the responsive supply is not really kicking in. It takes a while. So I still think gold's an enduring bull market. It's just a little stretched. It's a matter of time it breaks out above 3,500, gets to 4,000. A key catalyst will be when the U.S. stock market gives back some of its gains. And that, to me, is the key thing that the Fed and the bond yields and everything are waiting for. I look at the bond market right now as a very nice, not so much nice, appreciating put on U.S. stock market. U.S. Treasury long bonds, that long bond, 4.8%. The high for this year was 5.15. That happened right about the same time Bitcoin made a new high, 117, and came back. You see that tilt there? Risk assets go up, yields go up, and they go down. But this is a problem right now with the Fed. They're in a bit of a pickle. They will ease at some point. It's priced in the market. But they have to have I think the smart thing to do is let the markets tell them to ease. They made a mistake last time of easing and too much, which was last year. They used 4 times, 425 base point cuts, and bond yield spiked and said, "Stop! This is not good." Stock market blasted off and said, "Yeah, this is great. We love when you add liquor to the punch bowl at the party," and that's the mistake they made. They don't say it, but any astute investor gets it and knows that that's the biggest risk. Is they pump up risk assets too much. It creates more and more inflation. The wealth effect accelerates, and that's the problem we are right now. We still have sticky inflation. Duh, what do you expect? It's just, and then of course we have the U.S. government deficit spending at 7% of GDP, which is quite expensive. So to me, the next big trade will be gold making a new high, T-bonds catching up, Fed easing, bond yields declining, and the number one source for that to really kick in and stay that way is for U.S. stock market to go down. If it stays up, it's not going to last long. Yields won't go down much. Fed can't ease much. Stock market is basically so elevated here. It's just a matter of time it starts taking back some of that wealth effect. So it's also this key thing. You look at all the sentiment data, look at consumer spending in this country is basically flat over a 6-month period, which is not good. But look at construction spending is actually turned lower, it's downward. All the unemployment data, and it's not just the stuff that Mr. Trump pushed back, it's all heading lower. ISM services and unemployment heading lower, ADP heading lower. They're all heading that way. And all just waiting for the next catalyst. The key thing is what got us to this point where they're heading lower from? What plateau is it from? One of the biggest spikes in history. And that's my point, is I have to look at historical context of from where we're going. And I think this year, and then narrowing down to just a few months of signals. Yeah, okay, well, I didn't think we'd bounce this much this year, but now it's really about what are the next key things. I'm looking for all the signals. And that's why I start with cryptos. And I keep pointing out if they can show, more animal spirits, it takes the Fed out of the easing picture, but they're also showing very significant, I would say, diverse of weakness. And I expect that to accelerate as we revert.
Mm-hmm. One thing we hear often, Mike, is the idea that the Fed always acts too late. And, this is interesting to try to think about and to try to, let's say, wrap our arms around, because you just mentioned that the market needs to tell the Fed to act at this point. So how do we kind of square that circle?
So let's give an example of the Fed moving. Firstly, they moved way too much, not just the Fed, but in 5 years ago, we all thought we could die. We had a real reason for massive liquidity pump in the system. And then we didn't take it away fast enough. We did come up with vaccines within 6 months. I mean, human nature, with a little bit of necessity, invented things. But the S&P 500 started making new highs at the end of 2020, beginning of 2021. That's when the Fed should have started tightening. They were way too late. They started in 22, way far behind. Anybody trading money knew back then, like, oh, thank you. They're just pumping the system. And the problem is now they have to be late because they were way so late then. Everything's so pumped up now. The key thing is their job to just save the stock market every time it moves? Yes, when unemployment starts ticking up, it will. But at 4.2% right now, the unemployment rate for the last 12 months, the volatility of that change last 12 months is the lowest since 2002. So it's just stuck. I mean, I look at it, it's a bull flag. Unemployment goes up and sticks there. It looks like gold, except gold's at new highs. It's just waiting for the next step to go higher. Mm-hmm. And what we're seeing happening with some of the latest data, with happening construction spending, consumer sentiment, consumer spending, unemployment, everything is just kicking in. But what shuts off that is the stock market. I mean, that's, to me, it's what really pushed it up. So I don't, I hope it's different this time, but I just point out the facts that people need to recognize and realize that people are so addicted to stock market just goes up. I mean, I love hearing it from some of the younger people, and nothing wrong with being half my age, which is around 30. I'm saying in recessions will never happen again. There's only a few times in history you hear statements like that, and every time I've heard things like that, now obviously I've only been around for a while, and what I've read about other people hearing is usually it means you should be worried about what happens in normal capitalist cycles. So what stops it? What changes it? What show the other indications is we've reached, I think, the plateau of the Fed started easing for stock market crashes in 1987. And actually before that, they actually started doing stuff well before that, but that's the most significant one. Now we've lifted things so high that every time we have a problem, the Fed's supposed to save us. And they will, but I think what we're going to start now is a cat and mouse game between normalization of really expensive equities. Sure, they've got good reasons, got earnings from tech, but the concentration risk is the highest ever. And the cat and mouse game before the Fed easing and normalization of risk assets, and this could last for a long time. The question is, how low does it go? Now, it's already happening in China. China's running almost 300% debt to GDP. The 10-year note yields at 1.7%. And the latest PPI reading is minus 3.6%. Wow. Same thing that happened in Japan. I just, they're turning Japanese, and the whole world right now is resting on the U.S. stock market staying elevated. And that's why there's so much risk. And so I'll end with the most significant systematic risk, I think, in the system I've ever seen of one simple little market, and that's Bitcoin. So what happened was we got this president was smart enough to flip. He hated him before. He hated an asset that went for the U.S. dollar as its base layer. I was kind of thought that was silly, and it invested in treasuries. I thought that was kind of silly, but now he figured it out. And this space helped him get elected. But does it get any better now? And now the whole space is completely dependent on one person versus before it was more dependent on things like organic adoption and everything. So I think that's the key risk is Bitcoin could lead everything. And I think that's why I can't be bullish along it, because I think the risk goes down and takes the system with it.
Mm-hmm. Mike, we've heard a lot of kind of drama back and forth between Trump and Powell here. What do you think happens when we get a Fed that is far more accommodative? Let's say, what do you think happens specifically to the dollar when we get a Fed chair that is far more accommodative to Trump's policies here? And
I'm glad
the desire for lower rates.
I'm glad you went to the dollar. The Bloomberg Dollar Spot Index is down about 8% on the year. Let's just not forget, it was at an all-time high last year, just like the S&P 500 versus the MSCI ex-US index. It's the same trade. It's been that same trade, that stock market versus the rest of the world stock markets and the dollar since the bottom in 2009. And they both have tilted down a little bit. But they were so high that they have so much room for reversion. So the key thing I'm worried about with the dollar is that what pushed it up, U.S. stock market, is going to push it back down. And it's just so expensive. But it's also how you measure the dollar versus other fiat currencies. Is there a better major currency than U.S. dollar that pays T-bill rate of 4.5%? And has a stock market that's booming, except the problem is it's just so expensive, most expensive in history versus most other equity markets. So key thing I'm worried about is the dollar is going to go back down with that. I think it's also a vested interest of our president who wants to rebalance global trade to have a weak dollar. They won't not say it so much, but to weaken a little bit, give back some of those extraordinary gains of the last, 16 years or so. But one thing I want to point out I think is very, very positive and very counter de-dollarization is what's happening with crypto dollars. People call them stablecoins. There's a significant proliferation of stablecoins, 250 billion or so now. Scott Bassett said it's going to drop over probably 10x, and who knows what period. I think he mentioned 3 billion. I don't see why not. It's just a better way to transact. And once they figure out how to be able to pay interest, which is just a matter of time, it's just a better way to, you should be able to transact dollars globally like you can email. And I think we're getting there, but it also proves key thing I think that's remember in this space. So it proves how I think what the dollar, a lot of countries who now you can download a wallet and get access to the US dollar via your phone, and the average phone in India now you can get for $12. What I hear, maybe it's 13. Is any major country that has currency debasement issues, which we all know the major suspects: Venezuela, Argentina, Turkey. You just keep listing them
Parts
down.
of Africa.
Yeah, everything. They're going to, every citizen's going to say, well, sure, thank you, but I can get access to the dollar now. I'm safe, at least safer. I can protect some of my assets. Why would they use Bitcoin in that environment? Take a lot of risks. Now, they use it now because it's maybe about as volatile as their home currency, but then they're taking extraordinary risk. You can get to the dollar. So to me, what's happening in this space is it proves the technology is awesome. The world's adopting dollars via stablecoins. These things are invested in U.S. treasuries, but it also proves that Bitcoin white paper that said it's peer-to-peer cash is not true. It's digital gold, highly speculative, highly correlated to the stock market. But as far as peer-to-peer cash, you can use stablecoins now for that, at least getting to that point, which means de-dollarization is a myth, I think, to some extent. What we have seen is because of the war is a major shift to gold. I mean, this third largest holding now, central banks, dollar, euro, and now gold. Gold is picking up, but it keeps gold, I think, outperforming cryptos, particularly if the U.S. stock market goes down. And I'll end with this. I think this president we have has been called the crypto president. I think it's going to go down in history as the golden president so far this year. His first full term, Bitcoin's up 30%. I'm sorry, gold's up 30%, Bitcoin's up 20%. That's despite the stock market being up. And I think it's, here, I'll end with also the quote from Edward Chancellor, former UK Prime Minister: what we generally anticipate does not occur. Everybody expects one thing. That's why I keep tilting towards gold.
Yeah, that's really well put, Mike. One thing I've been trying to really wrap my mind around is, let's say, the size of the amount of demand that can come in from stablecoins. This is something that has been pointed to many times about really showing a new source of demand for treasuries, which is, going to be very important and needed and necessary within the treasury market. So how big of a demand vector do you think this is going to be? At this point, I think I read it's the seventh biggest source of demand for treasuries just this year.
Yeah, so you might be. You look at Tether, the largest crypto dollar, 160 billion. I hear the total is about 250 billion now. Virtually all that money came organically from cryptos and all invested in treasury. So this is a wonderful sign that I remember I loved writing about during Trump administration 1.0. So what are you not getting about how cool this space is? They're going for the dollar. They're going for treasuries. And once he figured out I could get elected, okay. But the key thing to remember is as technology improves and we get the regulation, it's not like that money just comes out of nowhere. It shifts from other areas. I mean, I remember Laura Shin on Unchained did a podcast with Cy Sheffield of Visa. Gosh, it was 5 years ago. And he was, the corporate Visa. And he said, yeah, crypto dollars are great. We can transmit, transact, and close out our dollar balances instantly. Why would we not do that once we can eliminate the risk? I mean, this is our business. So I think that's the key thing to remember. It's not just going to be organic developed from the crypto space. It's going to come from other spaces. This is a better way to transmit, transact, and hold your dollars than a money market. But it's just getting there. I remember I came from futures background. I've seen this. Mm-hmm. And I remember being in the trading pits on the phones with guys in New York, and they would be so mad when the Treasury futures would move treasuries. And I'm like, sorry, but it's just a new world. You can get leveraged and it's easy. Now it's all electronic. So that's the way I see it. But the bottom line is the technology is overwhelming. And it's the tokenization of all assets. What stops it? So when you get on chain, right now we have treasuries somewhat getting tokenized. Next thing is going to be probably, we have the dollar tokenized. Next thing is going to be treasuries and then stocks. When you can get that all on chain and within the same system, you can arb stuff that has earnings, or returns, and you arbor between the two, and you can make a little money on the arb, you're going to do that. But then you look over at things like Dogecoin that are worth $930 billion and track nothing and mean nothing. That's going to be short bait. To me, that's what's going to happen. It's going to, it's going to just put the adults in the room, and that's what's happening with Bitcoin. It's adulting. The minute when futures were launched in 2017, that was a really major milestone of the process, and you see volatility in Bitcoin has dropped since. And now that's in ETF space, it's major adulting, and we have such a pile-on of people expecting outsized returns. That's not going to go out so well. There's going to be a issue. But one thing to point out is the annual volatility, 260-day volatility of Bitcoin is now about 2 times gold. That's the lowest in history. And I think it's going to maybe spike a little bit in the short term, but continue to head lower as this whole space becomes in the mainstream. And the key thing is the outside returns that people got used to in the past, the insiders, the people who figured it out early, are getting out, and all the people expecting some returns, those same returns, despite lower volatility, and towards the end of the game, are going to learn the hard way about rapidly advancing technology and risk assets. And history always proves they go up really fast, and then once they're widely adopted, it trades over.
Mm-hmm. Well, Mike, that leads us actually really nicely into a different subject that I wanted to touch on with you. And this is the idea of investor psychology. You mentioned being around in 88, 89 for the Japanese crisis, in the dot-com bubble. So is this what really helped you to inform a lot of this counter consensus thinking and, let's say, systems in how you analyze these times in history when everybody seems to be kind of piling on the one side of the boat?
It's also that, and just being a student of history and markets. It's just funny. So I had an argument recently about someone saying, "Oh, Bitcoin sentiment isn't bullish." I'm like, "Have you seen the chart? The number one way to test sentiment is just look at the price." It's just start there, and then you're trying to dig into more details like commitment of traders and everything else that people like watch. But just look at the price. That will tell you exactly what the sentiment is, and look at it over time. It's the number one thing that got me bearish crude oil, technically, and then fundamentals backed it up in 2022 when it pumped to 130. I'm like, this is just the seeds of going back to 150 because it's what happens in history. Number one, it's the psychology. You always be careful when people are on one side of the boat. You want to tilt the other side, and it's also from an options trader. You never really get optionality when you're on the consensus, but you're going to get an option to get put on a position, get 10x. When you're briefly against the consensus, you get cheap prices to do that. And that's what I think I'm tilting my optionality right now, certainly against consensus. And it's becoming very much consensus to be bullish gold, which is a bit scary, but it looks that way. But it's also the lessons of markets in history, and particularly when you get to such extremes. And I just feel like my colleague Gina Martin Adams just quoted, we're in manic mode in stocks at the moment. And that could last for a while. Trying to short that, I've tried that. Buying options with negative deltas, okay, you can figure that out and maybe not lose as much. But it's a key trigger you have to keep in mind for what that means when it starts backing up for other assets. And then I look at for all the indications. What used to be a best leading indicator for all risk assets was the ratio of the ounces of gold for one Bitcoin. That Bitcoin to gold ratio, I really started jumping on board. It was around 2017 when it went above 1 for the first time, and it popped up to 40 last year. So far, the range has been around 25 to 40. That's right now, it's about 34 ounces of gold per one Bitcoin. I think the risk is it goes back down. But that indicator was a great leading indicator, and it makes sense. We have this new guard, digital gold, and then we have the old guard store value. And in an up market, and it had a high correlation to the stock market. But for the last 4 years now, stock market's making highs, but that Bitcoin to gold ratio is flattened out. To me, that's a warning signal. Now, sure, I could be wrong. The Bitcoin gold ratio could catch up, but all my indications are, now that we see this so much hubris and sentiment and people like Michael Saylor doubling down on one of the best trades in history, I just look at it from the future, Tom. I think, how's my book going to read? Is it going to read, it was different this time? Or is it going to read, yeah, it was just a matter of time. It's just picking the timing is harder to do.
Mm-hmm. Yeah, and you recently posted a news article about Amazon and about the idea of the crowd buying in when others are crying, and you trying to sell when others are yelling. It's such an important idea from history that I've described it sometimes as when you think you're experiencing this moment of clarity and basically thinking that you're so smart and this is the best trade ever, that's probably a good indication to at least take, let's say, half off the table, right?
It's one of the hardest things for us to do as humans. I am guilty,
really
admit it. I admit it. But when I start thinking I'm smart about markets, I'm getting it right, I usually get stopped out. I've learned that lesson. As I had a former boss who hired me, said, Mike, you say it a lot better than you do. And I'm like, yes. So now all I do is say it. Complete respect for you and for our listeners and our viewers who actually do it. Maybe it's better that I stay in the sidelines. I'm just overweight risk off assets. I can't deny that. I mean, can't. So we have compliance to check everything. And then when you're holding treasuries, there's not really to do with compliance. But that's the key thing to remember is what's the measure of that sentiment? And I see some of the extremes I've ever seen, certainly things like cryptos. And the key thing, the reason I posted that was from John Erkland. He was one of our former anchors based in Toronto for Bloomberg. He's on his own now doing other stuff. But there's so many people now comparing Bitcoin to Amazon. I'm like, absolutely the absolute wrong comparison, because Amazon in 1999, based on that Barron's article, was hated. People gave up on it or stopped out and most widely hated. When you have an asset like Bitcoin that's endorsed by a president, virtually everybody in administration owns it and loves it, and everybody's starting to buy it, you have to say, thank you very much. If you've made some money in it, probably better not to join the party here, because it's just what we generally anticipate does not occur.
Mm-hmm. Well said, Mike. I think that's a good place to kind of wrap up for today. Is there anything else that you'd like to leave our listeners to think about?
Well, I really enjoy your questions. I think we nailed it. It's the key thing. I hope, Tom, is the key thing that's unique about what I do at Bloomberg Intelligence. I'm allowed to express my opinion. I've been buy side, sell side. Certainly on the sell side, you have to support the firm. The buy side, you talk to your firm. The unique thing about here is I just write what I think, and as long as I'm not being an idiot with my language, my grammar, they're okay with it. So I think that's a benefit. And by the end of the year, if people come in and say, Mike, you were wrong, that would be delightful. The problem is just all of us need to think if by the end of the year we have a little bit of a down year for the stock market, that could be the beginning of a next big trade, which I still think is tilted towards simple risk offs like Treasury bonds, which some people would say is a risk on asset, but if you hold a maturity, they're not risky. Mm-hmm. So,
well, and I think the timing of this interview is also quite interesting. We have, again, going back to the idea of summer doldrums, and we do see typically, big things happen September, October. So once people get back from vacation, once people start paying attention again, see these earnings, I think, we can start seeing some big things start to break loose here.
Well, that's the key thing too. It's virtually guaranteed. Every trader on the planet knows you get corrections as you get through August and September and October. It's just the trade is 5% correction S&P 500. It's so completely broadcast. It should happen, particularly when you have volatility in S&P 500 dropping to 7.2%, the lowest in about 5 years. Yeah, it picks up, but it's what happens after that. And we should get the correction in the bounce. And I try to stay away from the bigger picture and try not to get sucked into. It's the bigger picture that matters. I'm just looking towards the end of the year. We basically need to be here or higher, or my scenario's already kicking in. And I see that like the key indicator has been gold and what's happening in China, and gold and bond yields in China. Those are key things that show severe deflation kicking in.
Mm-hmm. Excellent, Mike. Well, as always, I really appreciate your perspective on all of these things. Of course, all of your comments and a bunch of the links to your articles are all available on your X page at Mike McGlone 11. Mike, thanks so much for your time today. I always appreciate it.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.